One. And welcome everybody to another update. I'm Adam Sarhan. As always, I want to thank you very much for being here. Today's guest on Smart Money Circle is Zain Jaffer, who is a lifelong entrepreneur. He started his first venture as a teenager. He co-founded mobile advertising startup Vungle, which was acquired by Blackstone in 2019 for almost 800 million. Congratulations, Zain, that is a huge feat. And shortly afterward, he started Zain Ventures, which is his family office, and he invests in a diverse portfolio of real estate investments, among other things. And he's currently a partner at Bluefield Capital. Zain, welcome to the show.
Thank you so much for having me on here.
Thank you for being here. So Zain, I always like to begin. Can you tell us how you got started in the business and a little about you and your background?
Yeah, when you hear headlines like a big acquisition for almost 800 million, it's easy to think of it as an overnight success. Definitely not. I think when you said as a teenager, absolutely, it took years and years of just banging my head against the wall. So I grew up in a poor family in the UK, parents are immigrants, and I stayed out of trouble by building websites, and I kept trying to make money over and over again. And sometimes it worked. Often it wasn't very scalable. I'd be running my own agency, building websites for others, doing SEO consulting, whatever you have to do just to hustle and make some money. Mm-hmm. And I would say failure after failure after failure, right to the point where you just have no hope. You know, the last startup prior to the one that was very successful ended with one of the co-founders embezzling money. And
oh no.
You know, I remember at that moment, it was very dark in our London office, tiny office. And I was I'd finished my university. It was during the credit crunch. And there were just all these papers on the floor. And me and my other co-founder were looking at all these papers, and these were all like legal documents. And we were just thinking, can it get worse than this? You know, all our money's gone and it just sucks. But I remember that night, him and I looked at each other, we're like, no, we're going to fight through this. You know, and I think we need to cut our losses. Let's just have the guy settle the lawsuit and pay us a little bit, and let's go on to the next thing. And wow, you know, it wasn't an overnight either. It was like pitching VCs and getting rejected, and we just hustled, and somehow we convinced a few people to take a chance on us. We raised $2 million, and we moved to the US from the UK, and then we raised in total 25 million. And business was off, right? Started with no revenue, then 850K in the first year, 15 million the second year, 56 million the third year, 100 and something the fourth year, and it just kept growing until, you know, we exited the business. And it was one hell of a wild ride, and it was very tough. And, you know, those stats are true. 9 out of 10 founders will fail, and fail doesn't necessarily mean go to zero, but fail as in they won't make more, they'd be better off just working a normal job.
Right.
1 out of 10 is quite exciting still, right? And
yeah.
You know, you have to be swinging and you'll eventually hit it.
Are you familiar, Zain, with the power law distribution versus a normal bell curve distribution?
Oh, unfortunately, yes. I know. I invest in a lot of startups, and you know.
That's how it is. Yeah. In case our guests aren't familiar, there's a normal bell curve. Think of like a kids in classroom. Some get A's, some get B's, most get C's, and then D's and F's. But a power law distribution would be, let's say, for example, number of people in a city. You know, you can't say the average city in America has X amount, 200,000 residents, when you have the majority, maybe 10 or 20 cities have millions and millions, and then the others have hundreds of thousands or less than that. So if you're going to build a water system or a police system for the average city, you can't say, let's build it for 200,000 people, because the average city has 200,000 people, when you've got cities like New York and Miami and Chicago, LA, so on and so forth, that have millions and millions. So that's a power law distribution. And the same thing is true with startups or with trading. I see that, Zain, what you're saying, and that experience of just plowing through and overcoming adversity in so many businesses, and in any performance-based business for that matter too. Tom Brady had a good line too, where he was getting crushed in one of the Super Bowls, and he went to the halftime. He had the biggest, deficit ever, and anyone ever had. And he told his team, he's like, listen, we have one of two options. Either we lose and we got history as the worst loss ever, or we have the greatest comeback ever. He had the greatest comeback and won that Super Bowl. So what you're saying really rings so true. Can you tell us a little, now that you've hit it, you've made it big, the startup, you get the power law distribution. Now you have your own family office and you have Bluefield Capital that you work with. What is your investment strategy? What do you look for? And speak about that a little bit, please.
You know, even in climates like today, I still feel like I'm figuring it out. And I think that's part of being a good money manager. You have to be nimble. But overall, I wanted a well-diversified portfolio. You've got to realize where I came from. I came from a situation where didn't have much money growing up, didn't want to screw it up. Found myself having 100% of my net worth concentrated in illiquid startup. So that's scary because it's on paper. And you're going out for dinners with partners and you can barely make you can barely pay the bill and you're nervous about that. And yet on paper, you're worth just a crazy amount of money. And so there was this magic trick I wanted to pull off. The magic trick was, how do I take this money that's on paper and turn into something real that's in the bank account that I can access and that is much more liquid? And so that turned into, a big exercise. And I decided to create an investment strategy focused on the idea that ultimately I made this money because I want to, enjoy the rest of my life. I will probably do another company and I'm still working pretty hard, but I want to live a lifestyle and enjoy that lifestyle, but I want to see my wealth increase. So the idea is you live on a fraction of your interest. The idea is like you've got all this principal capital. If you can just figure out how to live below your means, and that's a relative term,
right?
And you take out some money out of the portfolio, but it's not so much money that it strangles growth. In fact, it's so little money that it's a fraction of your interest.
Right.
Then magic happens. You're living on a fraction of your interest no matter what happens. As long as you stick to that budget, the rest of your portfolio should over time grow. And so that meant building diversification. And there's many models of diversification. I came up with a model and I ultimately ended up changing it. But overall, on paper, it looks like 50% stocks with a little bit of bond exposure. I've been selling bonds because of the market right now and probably rebalancing into other assets. And then probably heavier than others. And some people might go heavier than others when they're young onto stocks. I have a lot of stocks, but I've also gone heavy into alternatives. Mm-hmm. And so if it's 50% stocks and bonds, a little bit of cash, the rest of it is basically alternatives. Mm-hmm. And I consider alternatives to also be real estate, which is a big chunk. So 50% stocks and bonds, 25% real estate, and then another 25% other stuff. That other stuff is maybe 10% private equity, 10% startup and venture capital, and then maybe another 5% what I call the anti-portfolio, things that just don't make sense. It could be cryptocurrency, it could be NFTs, metaverse, it could be just stuff that you're going to just swing for the fences with. It's not startups. For some people, that might be swing for the fences. For me, anti-portfolio is something that I just want to invest in because, I might not understand it, but I don't want to miss out in case it's big. And it really, it seems to pay off in this environment today where things like crypto have come out of nowhere. Right. So, ultimately what happens is you've got some of these will kick out cash flow like real estate, and some of these might be growth areas like private equity or startups, which you can't tap into. But the idea is, this will change over time. Startups will become larger and larger in my portfolio potentially just because, they'll be generating higher IRRs, and you want to sort of rebalance carefully over time. And I think you also want, and I might be atypical to most founders and entrepreneurs because I think I'm a bit conservative, even in the types of, real estate and stocks that I own. A lot of it's income focused. Mm-hmm. And I care about that income, the idea of compounding your wealth. I don't want to be 100% in growth. Mm-hmm. And I can scratch that itch, as I like to say, by doing things I'm passionate about. I've got a foundation where I contribute to causes, often anonymously, but sometimes more publicly as well. And then things I just like and enjoy, like startups. That gives me such a buzz.
I love
it. And also real estate too. So that's sort of my investment strategy.
Interesting. So Zain, how do you handle risk? And then what mistakes do you see people make with respect to risk management?
So risk is also a relative term. And one fallacy is to assume that the expected return is proportional to the risk you're taking. It's not true at all.
Right.
This is sort of, I think, a Wall Street mistake. A lot of veterans come in and assume, well, if that's got a high investment return projection, then there must be high risk. That's not true at all, in my view. It's more complicated than that. But ultimately, I think I veer towards lower risk when it comes to traditional assets. And I try to just find good money managers or other GPs. So there's a term here An LP is when you invest in someone else to manage your money for you, and a GP, a general partner, is someone who invests other people's money. I do a bit of both, but I came to realize trust experts find good managers. I had a really hard time with the idea that I've made all this money. I'm now going to give it to someone else, and I'm going to pay all these fees. I'm going to pay management fees. I'm going to give a promote or carry on the returns they make me. But then you realize, wait, this person day in, day out just is an expert in their narrow field.
Right.
They're going to do way better than I can do. So for me, it makes sense to find great stock managers or great fund managers or whatever. I at this point, I have well over 50 different general partners who manage different aspects of my portfolio. That allows me then to invest more actively in things that I enjoy.
Right.
And if I'm going to invest other people's money, and I do that through Bluefield Capital, which is a different entity, it's a private equity fund, hundreds of millions of dollars under management, billions of dollars worth of real estate. I'm a general partner there, manage other people's money alongside a great team. That's something I do day in, day out, and I'm an expert in, buying real estate, and so is the team. And investing in startups, that's something I do day in, day out. Right. However, I've made a lot of mistakes. There are things that, you want to do day trading and you're going to get your butt handed to you. It's better to find a great hedge fund, or, you want to pick. In me, I thought I'd be good at this, picking tech stocks. I'd much rather find a good manager. I use, we might want to talk about this, a range of managers, and I'm a big fan of Cathie Woods, who's been beaten, in the market and just has developed sort of a meme, ARK, which is ARK Invest. It's an ETF, but you can invest directly. She's like the venture capitalist of stock picking, and she invests in very, very high growth tech stocks where valuation and bottoms up analysis is not the primary way of doing it. And her returns have been awful this year, but have been generally amazing over the longer term horizon. Right. So I really like that opportunity now because the market's low, and I don't have time. Here's what happened. When you have all this money, you start, you should see my mobile phone. I use the Yahoo Apple stock thing, and it's just every day I wake up and I'm looking at it, and I got to stop doing this.
Yeah.
And your friends will start texting you, oh, Lemonade is down right now, or Uber is down, or Uber or Airbnb just announced this, you should go invest. And you get carried away before you know it. You're spending a lot of your time going on Robinhood or going on platforms and making trades, and you need to get away from that. That sucks up mental energy. Before you know it, you're checking your stock. So that's why I wanted to go and find great managers who I trusted could do things. And I gave an example of Cathie Woods, and the reason I gave her as an example is I feel like I didn't like the current index funds and money managers for tech stocks. I liked her because she picked Tesla very early on, and she's got some really crazy theses, and she publishes those theses, for the public, and got very excited by that. And I thought, you know what? I like the stocks she's picking, and she's trading for me, right? She's not just picking stocks and leaving them. She'll trade when there's opportunities, when stocks are down. And I sort of did an experiment. I put some money with her fund. This is ARK Innovation Strategy. So it's sort of it mirrors the public ETF, but it's a lot cheaper to invest directly with her. And, a friend would text me and I'm like, okay, that's interesting. And I look and Cathie Woods has already traded that position. That's good. Now I can start deleting those stocks off my watch list, and I can focus on things that actually add value. Right. So what I'm coming back to here in a full circle is you want to not be a slave to your money, because often the more money you have, you become a slave to it. You want to let your money work for you by trusting people who align with your vision, the way you would do things, which then frees you time to do things that you're passionate about, that you enjoy. In my case, it's investing in other founders and focusing more on, value add real estate opportunities, and a lot less on, oh, look, the stock is down today and that stock's up today. And, let me make a quick option trade, which is also very addicting,
Yes. Yeah, actually, Zane, what you're saying rings really, really true. I just published a new book. It's called Psychological Analysis. It's #1 on Amazon. It came out 3 weeks ago. It's been #1 every day since. And in it, I talk about exactly what you're talking about, the mental capital and physical capital, and how if you sit there and look at every tick, when you have bronchitis or any other kind of itis, I call it tickositis, where you're like, oh my goodness, you just like sucked into you, and then blink your eyes, next thing you know, the whole day goes by and you've lost money, and it's like, what just happened? And nothing happened. There's no productivity. So I smell what you're cooking 1,000%. So
it doesn't just apply to stock picking or transactional or automated trading or whatever, right? It could be commodities, crypto, anything. It also applies to any investment activity you do, and sometimes active investment or actual operations. So I started out trying to build a portfolio of real estate, single family homes, hard money construction lending. I tried to build out portfolios of multifamily buildings. I personally own hundreds, I think 400 or 500 units myself that are in multifamily. And I also gave some to other GPs who do this for a living. And there I am taking calls from tenants because the plumbing isn't working.
Right.
I'm having to figure out, I got to pay these taxes. I got to file my K1s now. I've got a crazy amount of paperwork. And when all is said and done, you realize, wait, I made how much?
Right.
I made X.
Yeah.
And I gave money to these other people and they made Y. They made more than me. How is this possible?
Exactly.
I thought if I do this myself and I'm really actively involved, I'm going to be able to save money on fees. And it's such a fallacy. Yeah. Just trust experts and let them do it for you and decide what you're going to do and be the best in the world at it. And if you're not, like I certainly have to admit, it took me a while to understand real estate. So I partnered with other people, and now I've got a team at Bluefoot where you can learn from. And there's no shame in doing that. Often there's this ego. Like I had an ego, I built a company from scratch. No one believed in me. Everyone turned me down.
Right.
Damn, I built this company from nothing. To investors thought I wouldn't be able to, even generate $1 million a year. I was generating $1 million a day in revenue, right?
Right.
This thing will never sell for 10 million. Well, how about almost $1 billion, right? So you do develop this ego, and as a CEO, eventually you realize stop listening to others, right? You don't surround yourself by yes men. You make decisions, and a lot of people. The very people who tell you when you're running a company you're going to fail, and the media or the industry, are the very people who are glorifying you. Wow, you were such an innovator, such a disruptor. So you start to think, I can do this myself. And that was a learning curve, because when I sold my company, I thought I could do everything myself. And then you realize, no, don't try to do everything yourself. Find experts instead.
Yeah, and pay them well. That's really, really smart. If they weren't providing value, they wouldn't be in business, right? So clearly they're providing value. And yeah, I fully get that too. Okay, so the way that you would handle risk is by diversifying your portfolio, number one. Number two, making sure that you allocate to experts, pay them well, and let them do their job, almost like get out of their way. And then the third part, if I understand you correctly, is to focus on the highest ROI activities that you could possibly do. Like the top 1%, forget the 80-20 rule. It's like 99-1, right? I have that in the book too, where it's like, just focus on the stuff, the most critical, highest level, highest ROI activities, and then almost outsource the rest if at all possible. Is that more or less what you're saying?
More or less, I'd adapt that last part to say, sometimes if you want to focus on the best ROI activities, ROI can only be generated in an area where deep expertise is needed. So bring in someone who's an expert in that area. Yep. Instead, focus on areas that you love and you enjoy. And it's more than about money itself. So for me, I can invest, and I've invested, I don't know how many, maybe 10 different venture capital funds. It might just be because I know those VCs, maybe some of them invested in me, and I love that. But I could be done. I could be done and say, okay, here's my exposure to startups. I invest in 10 VC funds. No, what do? I go and invest in startups directly as well, because I love it. And the truth is, maybe these VCs will outperform me, because these VCs have been doing this for a long time and they've generated good, they've got a good platform. Here I am investing in startups myself. Maybe my IRR might not beat theirs, but I love what I'm doing. I just love talking to founders. And for me, that is the best ROI. And every time I invest in a startup, I want to meet the founder and talk to them. I don't like the idea that I'm just passively investing in a fund and they're doing all of that. Right. They'll make more money probably, and probably not. So my portfolio is doing really well. The power law works. Right. The more investments you make, the crazier the returns there are sometimes. But do things you enjoy as well.
Yeah, I meant ROI is not just money, but overall, like what do you enjoy the best? What's the best return on your time? So yeah, I love that too. Thank you for clarifying. Okay, what are some timeless lessons you've learned along the way? Like if you could go back to when you were 20 or 30 getting started, what advice would you give your former self or share with the audience? Right, there's a lot. Feel free to go as much as you want.
So if you rewind back a little bit to the start of this podcast, I talked about my story, and many times success comes right when you're about to give up, when you feel like there's no hope left. I gave that analogy in that dark room we were in after, trying to sue this other guy in court for stealing our money, and paper after paper on the floor. And you're like, how are we going to get through this? We don't have a company anymore. And just when you feel like quitting, that's when there's a break. And that's when your mind somehow creates opportunities. And it's almost like a test from the universe.
It's so
Where
true.
I feel like if you really want it, you have to prove you're hungry for it.
Right.
And that's going to give you that metal, that strength, that armor to pull through anything. So that's one. Success comes right at the point where you feel like you're about to quit. And maybe it might be, you know, after you've broken your leg in that marathon and you're still crawling beyond the finish line. It comes around that time. Okay. So
Right.
have faith in that. And then the other thing is and I think this is a unique perspective I can offer, because I can say a lot of generic stuff, but I want to say something I think is more, you know, some wisdom I've learned, right? Being a founder and being an investor are completely different skill sets.
Right.
And
Very powerful statement. Yeah.
And even being one type of investor, that doesn't necessarily translate to a different type of investment asset class. So I'll
Right.
give you an example, right? I run a venture capital fund as well, where we invest in a very narrow vertical, which is prop tech.
Mhm.
And I also invest in real estate. Now, the way you look at investment opportunities need to be totally different. And even as a founder too, it's the same. A founder and a VC look at the world in similar ways. So when I'm talking to founders, I'm really embedding on the person. Everything they're telling me, that's what I put a lot of weight on. You do not want to take that same approach in real estate. If you're buying real estate and you're believing what the broker's telling you, you're believing what the seller's telling you, you are toast, right? In the same way, you need to look at those financial spreadsheets and you need to do a lot of modeling and you need to look at comps. That is a useless activity when it comes to startups and founders. If you're investing in startups, a spreadsheet's so useless beyond understanding the assumptions. It doesn't really matter what they're projecting for year 3, 4, or 5. You just want to understand, or even year 2 for that matter. You just want to understand what are their assumptions, what are the drivers of growth, is the market big? But you know, it doesn't really matter. I'm betting on the person.
Right.
So I believed a little bit too much initially, you know, in the vision of what the realtor's telling you that you can do with this property and how you can turn this into an amazing, you know, vacation rental and, you know, selling you emotionally.
Yeah.
And you got to be careful if someone knows you have money or you're calling from a zip code like California.
Yeah.
You're calling out of state, like I was calling out of state to Texas, and all those brokers love it when the 650 or 415 area code is ringing up.
100%.
You know, hi, I'm looking to diversify. You know, I live in Silicon Valley. Oh, please come over. We've got some great off-market opportunities for you.
Of course.
You know, you're paying 30-40% more, and so you learn that way. And that probably brings you to another one. And this is a really sad piece of advice. Really sad because I'm a trusting guy. I'm a founder at heart, and I like to view the world through these rose, you know, tinted spectacles, and I like to give everyone a chance. But you've got to be very, very, you got to have your guard up all the time. People are trying to rip you off constantly. There's a whole shadow industry of these unqualified brokers and broker dealers who aren't qualified and will bring opportunities to you, sell you snake oil, will try to, you know, appeal to you emotionally. And I've seen this, you know, if you're a very ultra high net worth individual, or you run a family office, you're bombarded with people offering you opportunity after opportunity. And eventually you develop this like spider sense. You have to get screwed a little bit to develop it, but you're like, you know, this doesn't smell right.
Right.
The easiest, you know, I'll give an example. I'm not going to name names here, but you get a lot of people that talk a lot of talk, right?
Right.
And they'll come to you and they'll be like, you know, I'm interested in buying your property. And there's this whole thing in real estate where you can put a deal on the contract without actually losing any money. You can just tie it up, right? And one thing you always do as an investor is reference check the hell out of everyone. Now I do that even whether I'm investing in a founder or whether I'm investing in real estate or, you know, a money manager. Reference people. And if someone is sort of, and I've had this happen a few times, they get insulted. Well, what are you trying to reference me for? You know, I'm a respected person. I've done this, I've done that. I can close fast. Well, sir, if you can, all I need is a few references. You know, I gladly give references to people when they work with me because I want them to know. I do what I say. And I had one guy recently who wanted to put some of my properties under contract. And I was like, okay, great. Well, you've done all of this. Just can you quickly introduce me to a few other sellers who you've, you know, done business with? Oh, no, I can't do that. I like to keep things confidential. And you know, when you dig in deeper, you're like, whoa, This doesn't feel right. So if you're new to money, if you get rich quickly and you haven't built that, muscle, you're going to be tempted to make a lot of decisions and trust people. Don't.
Mm-hmm.
Fortunately, if it is too good to be true, it often is. Reference check people, and if someone ever puts up resistance to being referenced, walk the hell away. Honestly,
right.
run away. And when you do the reference, the number one question you start with is, great, how long have you been doing business with that person? How do you know them? The amount of times I've heard, well, I know him. I've known him for a while. How have you known him? Well, he's my brother-in-law.
Yeah, exactly.
Right, or he's my cousin. You're like, okay, this is not a biased reference.
Right.
Not a biased reference at all. And also don't just do a character reference, because that's hard to kind of validate. Go deeper and reference things like, tell me about the transaction. How long did it take to close? What was the process like? Go really deep and detailed, and then you'll realize that, oh, okay, this isn't as clean as you thought it was.
Right.
Because when you enter a contract, even if you're selling a company, for example, right? And I had this happen with some large tech companies. Some very large tech companies wasted our time too. They pretended they were interested in acquiring us and wasted our time, and I'm there distracted, or even VCs can do this. So you really want to make sure that once you have all the leverage before you enter into a contract, like negotiating with the Chinese, for example. I did a lot of business with Chinese, and over there, we made China into a huge revenue stream. It was second largest revenue stream for our business. But in China, it feels like the negotiations happen after you sign the contract, not before.
Oh, wow.
And so this phenomena is dangerous, because once you're under contract and people start to trade terms on you, you've lost your leverage, and then you sort of, as they say, become pregnant. You're pregnant now with this deal. You've told your team you're going to do the deal, especially if you're selling a company. You have to give concessions, and the deal isn't what you thought it was. So do all your due diligence before you enter into a contract. That's
a really, really, really great set of lessons. And it's funny, Zane, this is our first time ever meeting or speaking, but there's so many parallels with what you're saying and your experiences and what I've observed and even wrote about in the book too. I have something called the 1 second rule, where you can give up almost one proverbial second later, boom, it would go your way and hit. Whether you own a stock and you can't take it anymore and you sell it, and then right away it goes up afterwards and you're laughing, or you own a business and you can't take the pressure anymore, you give up. And then had you just held for that one more proverbial second, it would have worked and gone. And then same with your other points too, the reference checking is so critical. And I love these lessons. These are really, really, really good. And it's amazing how in the book, I say winners win. There's literally that's one line in the book. And what you were talking about too, where it's like, okay, you're going to do something, you get that smell test or that the spidey sense. I just watched Spider-Man with my kids the other day, and you get that spidey sense. Something doesn't make sense here, something doesn't smell right, and you walk away. So Warren Buffett has something called the circle of competence, and he goes, I just know what I know, and that's it. He missed the 1998 to 2000 tech bubble, and he said, it's okay, it's not my circle of competence. So you master the art of saying no is what I say. And just look for that one gem to say yes to. But wow, it's almost like the same language, but two parallel different stories, and here's the intersection of them. But yeah, winners win. It's just that simple. Okay, that's fantastic. Those are a lot of great timeless lessons. Thank you for that. What about some timeless?
I want to add another timeless lesson too. Plan the trade and trade the plan. Okay, so try not to change your way halfway through the process. Be strong. Understand your initial conviction, because you're often right. Sometimes write an investment memo if you must, and I do that for our VC investments. That way you can go back and understand, here's why I invested, what my thesis is. And the other thing I want to depart is wisdom, especially as this is a lot about advice in this particular podcast. This is a very tech Silicon Valley mindset, but I really believe in it. It's not cutting your losses in the winners as much as holding on for dear life sometimes, holding on and letting that thing ride. And the greatest VCs have understood this. Sequoia Capital, one of the best VC firms, has changed their investment horizon and basically will hold forever if they must. Because once that thing starts to grow, especially in startup land, right? My God, wow. And the fact that some of these assets like real estate and startups are not liquid is actually a blessing, because then you can't just go to Robinhood and hit sell. You're stuck and you have to ignore it. It can grow, and when it grows, it can grow 10x, 100x, 1000x even, some of these things. And so holding on to your winners, whether it's a public stock, whether it's a real estate project, or whether it's a startup, holding on and just letting that thing ride. and sometimes holding on for a long time. You know, if you held on throughout the early times in the markets or crypto or any asset, you'd be much better off than trading in and out.
Yeah, I couldn't agree with you more. There's no question. Again, in the book, Buffett calls it the Great American Tailwind, or he calls it the American Tailwind, right? I call it the Great American Tailwind just to make make it a little different. And it's so true if you just hold on to the winners. But let's talk about the losers for a second, because this next question is about mistakes. What are some timeless mistakes you see people make? Would you say doubling down and owning too much of their losers, or would you say, keeping those losses small, or how do you handle all that? And what are some mistakes you see people make?
I mean, it's down to emotions, and there's this idea that I'm buying this because it's low. Wow, it's dropped even more. Let me keep buying. Okay, it's dropped even more. Let me keep buying, and eventually you end up holding a falling knife,
Mhm.
and you actually have to be willing to buy on the way up as much as you are on the way down.
Right.
Dollar cost averaging is such a true time-tested strategy. When you're entering into an asset, you just keep buying no matter what. Like I do that. There's a few money managers who I'll dollar cost average into even more than my initial. And like Kathy Wood's ARK right now. I don't care if the ETF or if the thing is down. I started investing around 120. It's now down at 78. I don't care. I'm investing every month.
Right.
As far as I see it, if it's down for the next 2 years, I get to reduce my cost basis. And if it goes up, who cares? Like it's supposed to go up. Just keep investing no matter what. Always be investing. Create sort of a system. And it goes back earlier when I said, you live a lifestyle where you live on a fraction of your interest.
Right.
Well, also keep deploying the rest of it. Always be deploying and compounding. Beautiful, just beautiful, like what compounding can do for you.
It really is. It's the eighth wonder of the world, right?
It certainly is, yeah. And
I love it. Yeah. Sorry.
Yeah, in terms of other mistakes, there's just so many mistakes you can make. Go make sure that investing doesn't take up your life unless you're a professional money manager. If you're on the LP side and you're investing with someone else, trust them. I mean, trust but verify, obviously.
Yeah.
But don't micromanage and don't actively become a day trader because you will lose. Ultimately, eventually those hedge funds have a lot more technology than you do.
Yeah.
I see a lot of amateur mistakes. Me too. I started, shorting the markets at some stage and trading in and out of stocks, and it was a mistake.
Yeah.
And don't do that. It happens way too often.
I always tell people there's no billionaires that are day traders, but there's many billionaires that are investors.
Yeah, exactly.
Yeah, or even position traders. Okay, fantastic. I guess the final question I have for you, Zane, is what's the best piece of advice you'd like to share with the audience?
I feel like we've imparted a lot of advice. Ultimately, time is very precious. You only live on this planet for a fraction of its existence. And so do something meaningful with your life and your money. Mm-hmm. I've had a lot of people who have come and have said stuff like, one day I want to help my parents and I want to save up for their retirement and I want to contribute to these social causes. These are really noble causes. Why are you waiting for a magic number?
Right.
I was working with someone who said, look, when I reach $100 million, I'll be so much happier because I'll be able to do X, Y, and Z. And I said two things. Firstly, I've got well over $100 million and I'm not happy.
Right.
Okay. I'm still just as unhappy as I was before. Now I want $1 billion. It doesn't stop, right? Just know that the pursuit of more will make you will never make you happy. Secondly, why are you waiting? Here's what you do, okay? And this is advice for anyone who's waiting till they reach a certain milestone before they do something. Here's what you do, okay? Whatever income you have now, just take 1% of that income and put it in an account for your parents. Mm-hmm. Even if you're making only $1,000 a month in extra income,
right? Take
$10 and put it in that account and don't touch it. Okay.
Right.
Take another 1% for other causes or whatever it is you're saving up for, and put another 1% there. Just keep the number small at 1%. Okay.
Yeah, 100%.
Now what you do is you obsessively measure, and you're like, okay, last month I put $10 in. I'm getting closer towards this noble goal of helping my parents retire. Mm-hmm. Okay. I'm just making this example up. There could be so many, right?
Right.
Now it's $11. Now it's $12. Before you know it, one day there's $1 million in that account, and you're worth $100 million, but you're 100 times happier because you enjoyed the process and you were focused. There's no true action than doing something, than saying you're going to do it. When I make $100 million liquid, I'm then going to go $1 million to here and there. No, just start doing it now, man. Just start doing it now.
Yeah.
And it will eventually happen, and you'll enjoy the process. So that's, I think, advice that is actionable, and it's just amazing what you can do once that's in place. I did that too, and I was amazed. I'm like, okay, this is growing. What I did do though is I dipped into my savings a lot, started gambling when I didn't have much money. I started buying stocks and trading, and I kept losing money. And that was a really good lesson for me, because then once I lost, when I was CEO of the company, eventually I was making hundreds of thousands in salary, right? But I was only saving like 50 to 100K.
Right.
And here I'd be like, okay, I'm gonna go invest in public stocks because I want to make more money, and I'd lose like everything.
Of course.
It's a good lesson, because later on,
when you had more, right,
you're less likely to screw it up. So if anyone, especially there's a lot of investors who are listening to this, they're going to make mistakes.
Right.
Some people probably come back from nothing after investing and losing. It's very, very depressing when you work for a long time, for like a few years, you save this, and you can blow it in like a trade.
Seriously.
Right? Careful. But you will bounce back and realize next time I'm not going to make the same mistakes. And also, this was actually a really powerful learning lesson, because when I have more wealth, when I have 1,000 times more wealth than this, I will not make the same mistake, and I will only lose a fraction.
100%. No, I love that. So you're basically setting, people are creatures of habit, right? So by doing that 1% or 2% or whatever number you want, you're creating positive winning habits, and you're doing something right now to plan for the future. So when the future comes, it's almost like The Slight Edge. If you're familiar with that book, it just take a little bit every single time. Over time, you just work and it wins. It's much better than just saying, wait until I get $1 million or 100 million or some other arbitrary number that you just pick randomly out of the hat. And then once you get there, the number changes, like you're saying, because it doesn't make you happy. It's just a material thing, and that comes and goes. But that happiness comes from within. So, okay. I love this, Zane. So I'm gonna ask you one more question here, because I love picking your brain. Let's talk about the psychology. When you had a shift, you said you started with nothing, like me. I couldn't pay for bills and dinner, and I know exactly how that feels till this day. And you shifted. You had a lot of success, and you shifted the mindset. Can you talk a little about, were you a pessimist at the beginning, or were you optimistic at the beginning? Were you unhappy early on, and now are you happy, or are you still unhappy? Can you speak to that a little bit and let us know a little about your evolution from a mindset standpoint and psychological standpoint, if you don't mind?
I think I was wildly optimistic, but I was easily swayed by other people's opinions, because I felt like they knew something I didn't know. They were wiser than me. There were a lot of pessimistic people, and this is the worst thing that can happen. You have a hunch, you want to follow it, someone talks you down from that ledge,
right?
And they were wrong. You're going to really resent it. You would have so much more. You should have a lot more ownership in the decision. When you fail, you were wrong, you own it, you pick up and you keep swinging. Right. It's not cool that you didn't swing because someone else told you not to. Follow your gut. So I started off very optimistic, but I was easily swayed by the people's views and opinions. And then I became stubborn, and I went to the other spectrum where I don't listen to anyone, and I built my company like that, right? And that is, you're still optimistic, but you just don't listen to other people. Sounds like, and you look at this pattern of people that are in a high-tech company. You look at people like Elon Musk and others, they tweet crazy things, and they just don't listen, really, it feels. That works very well when you are the king, and it's your empire and you run everything. But it doesn't work very well once you're not the king anymore. It's not your empire, and you're just managing money now. Right. At that point, you really need experts, and you need to remain optimistic, but you need to be balanced. And so, really, there are certain times in your life where you need a certain mindset, and you can't try to have this one-fits-all approach. I'm not here to say to your listeners, be balanced.
Right.
Look at everything objectively. No, don't. What's the point? You look at where you are in your journey and decide, if I don't do this, will I resent it? I think I want to do this, and I want ownership in this decision, and I'm playing a game here.
Right.
Who knows what's going to happen, but I got to swing. So decide what the strategy needs to be for this particular round or stage that you're in. The stage I'm in now, I absolutely need to listen to others, because when you have a lot of money, you can easily blow it.
Oh, yeah.
So you need guardrails for yourself. Like I have an investment committee for my own family office. I have my closest trusted advisors, and I will make sure that I try to stay true to my portfolio allocation. I'm someone who, you know, loves to double down on things when they work. I mean, I was a founder, and unfortunately, when you have 100% of your net worth in, you know, a stock, and when you've been broke as hell, you never want to go back there, but you're not uncomfortable anymore. You're like, I can deal with stress. I can deal with risk.
Right.
I can imagine myself wanting to keep investing in, if I do another company, to put like $100 million into it, right? That would be reckless. Instead, you know, I can fund it to a point, but no more than a certain percent of my net worth. And then I want to bring in other people's money.
Of course. Yeah.
And very successful people actually don't just put their own money in, they bring other people's money on top as leverage.
No, 100%.
This is what becoming a money manager means. You put some of your own skin in the game, but you bring in leverage with others, and you're not just bringing other people's money, you're bringing in their expertise, their advice. This doesn't apply to a company. It could be like, you know, I invest in real estate and I raise money from other people too. I raise money from brokers, from other, you know, real estate people, from other high net worth people. This is a network of people that can help me be better too. So that's also another mindset shift. But when you do that, you know, you have to be willing to take advice. And also when you manage other people's money, you have to manage it differently than you manage your own money. And I know it's weird to say that.
It's true. It's so true. Yeah.
So some people say, well, why? You should manage your money or other people's money exactly like your own. Right, you're saying no. For listeners who can't see you on video here,
right?
No, right? You're lip syncing that.
Yeah.
I'm okay losing my own money. I'm not okay losing someone else's money. Unfortunately, that means you're not willing to take as many risks. But I frankly, I just cannot. I cannot. Remember when I raised $25 million in venture capital, it screwed up my psychology. When I raised my first friends and family round, hundreds of thousands of dollars from friends and family, no, it was tens of thousands of dollars actually, right? At the beginning, I couldn't sleep. It's like, oh my God, what if I fail? This is a lot of money for that person.
Right.
So, and I know, like, when you're taking money from people, like, you've got to realize you're just part of the diversification. They want you to take risk. I still have a really hard time with that, though. I don't want. It's a lot of burden managing other people's money. Other people aren't like that. Other people are happy to take your money and go make crazy bets. Me, I don't know. It's the way I am. It's probably a weakness. It doesn't make you the best money manager, but I have integrity, and I would rather lose my own money than someone else.
I fully understand that, and I smell what you're cooking there, 100%. Well, Zane, this has been absolutely fantastic. I can't thank you enough. This has been a ton of timeless lessons and a ton of advice that people can watch and rewatch and benefit from tremendously. So thank you kindly for coming on the show, and hopefully we'll have you back on again soon.
Great. Thank you for having me on too.
Thanks, Zane.